Hello, Prolette. Let me just verify that our speaker is going to be here. I had a conversation with his. Oh, I probably don't have my microphone connected.
No, we can hear you.
You can hear me? I think it's going through my laptop.
Okay. Always a stressful moment when you're not sure the speaker's going to arrive. So,
Well, I talked to his assistant um,
hmm.
about an hour ago, and there was a time confusion. So, all right. There he is. Looking much more professional than I look currently. I'm in my cozy sweater. Hello, Brandon. Thank you for accommodating the time. I know there was some mix up in our calendars. Oh, you're on mute still. There we
There
go.
you go. Yeah. Now you can hear me. I was like, why
Excellent.
are you not responding to what I'm saying? How you guys doing?
Good, good. We're gonna wait just a few minutes here to let
Sure.
people join. Let's see. I want to make sure I'm on my better microphone here. Can you hear me now? All right, great. Welcome, everybody. We're gonna wait a few minutes to let people join. We'll get started around 12:05. Until then, let me know if there's anything that you would like to talk about in our upcoming meetings. We do these meetings every Friday, just about. I think we've been averaging 47 over the last 7 years, probably on the track to 45 or 46 this year. But it's on a pretty regular basis. And so if you have any topics that you want to hear about, whether it's on commercial real estate, Airbnb, taxes, oil and gas, if you want to talk about other types of funds, we've occasionally brought in creative funds like art funds or whiskey funds or other types of creative financed funds. Um, if you have a topic that you want to talk about, feel free to drop it in the chat or just take yourself off mute right now in the first 5 minutes. Feel free to just to speak up. And we're going to wait a few more minutes for people to join. Probably get started maybe when we hit around 50 people. Anybody have anything interesting they're doing right now? It's for those of you who had your tax extension done, it's probably a busy time for Brandon right now, come to think about it. You working the late hours, Brandon?
Luckily, I have hired very capable and smart people, so they handle that. So no, not
Excellent.
anymore. But our team is grinding. Yeah, yeah,
Yeah.
they're cranking stuff out, and I'm very thankful for them.
I'll start off this show or this meeting just saying I'm thankful for Brandon's podcast. I have been a listener to your podcast for years now, I think.
Nice.
Multiple years. I don't know, four years maybe longer. I'm not sure. How long have you been doing it?
So I started in 2016. Well, the
Okay.
podcast I think I started in 2018, maybe
Okay.
2019. So yeah, somewhere around there. Yeah,
Yeah.
yeah,
I've been a listener for most of that.
yeah.
Lots of scam emails about your taxes being due now. Yeah. I got a scam email about medical bills just 2 days ago. Not an email, a phone call.
Yeah, the scamming is getting very, very good, especially with AI. They're starting to use AI to like make it all look very legitimate.
Yeah.
We've dealt with that a little bit with our clients.
Yeah. 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 Well, the medical, they said they were a collections agency. And so I said, okay. And then, of course, they asked me to verify all my information by asking me to give it to them. And I said, no, I'm not going to give you my information. Not until I know who you are. And then they gave me a website, very official looking website. Okay, looks interesting. Looks like a collection agency. So I contact my medical provider. Never heard of them. Yeah. I had a friend also who was looking for a job this year. And she loved the podcast. Super excited for today. Prolet is in the investor community, and I know she's very active. And so, yeah, I think with your podcast, you're a bit of a mini celebrity, to be honest. I bet you are.
tax
We're
celebrity.
lucky to have you.
Yeah, thanks.
I was going to say my friend who was looking for a job thought she was being talked to by a recruiter, and the recruiter took her job application and then immediately used it in order to steal her identity and do all sorts of things that she had to unwind.
Wow.
She thought she was getting a job. Here she was. She wasn't currently employed, and scammers pretending to be job recruiters.
A couple of years ago, we were interviewing a guy who we later determined he was uh identity theft or fraud or whatever. But anyway, he was putting himself out to be a CPA, and he wanted a tax job,
Hmm.
and we were hiring a higher level role in our company. So in the tax world, you go like associate, senior manager level. So we were hiring a senior manager level, and typically you pay those folks like 180, $200,000 a year, and he wanted 120K. And so we were all like, "Oh, cool! Like we're getting a deal." But then there are a couple other things in the interview, and I watched all the interviews, and then I interviewed him myself, and there were just a couple odd things that he was saying. He said that he'd brought like $1 million of business in the last 12 months, and then that's when it all clicked for me. I was like, "Wait a second, you're crushing it, but you're only 120K, and that's way below what you'd normally pay a senior manager." So we started doing some deeper due diligence and realized that he had totally impersonated another CPA that's actually local to me. So I contacted him and the state board and got all of them involved. That was crazy. It was very
And yeah,
bizarre. You can
yeah,
just hold
these
yourself
these
out to be whoever you want on these interviews, I guess.
yeah, and AI is certainly not making it easier. Uh,
Yeah.
to, Today I'm sporting my Life Bridge Capital tumbler. Shout out to Whitney Sewell, who's been a speaker here before. I don't know. Does anybody, if you know Whitney Sewell, go ahead and throw that into the chat. And let's kick it off by first of all asking everybody, like I often do, where are you coming in from? Just to let you know, Brandon, this used to be the Intel Real Estate Club or the Intel Real Estate Education Club. I'd throw that in there because Intel required us to be nonprofit. So it was basically just bringing in speakers every week to help all of us learn and grow. And so if you're on the meeting right now, go to the chat and put where you are coming in from, the city and state, and that'll give us an idea of where you're coming from. Just to let you know, Brandon, most of the people around here are centered around Intel campuses. So you've got your Folsom, your Portland, your San Jose, your Chandler, Arizona, Mesa, and then we've got, since the pandemic, people cropping up in Texas, Idaho, Montana. Hello, Montana. Portland, of course. I'm in the suburbs of Portland. And multitasking, working on my taxes. Brandon, I hate to admit it. This year, I'm normally very good at getting my personal taxes in on time. This year, my
What they
CPA is
all
mad at me.
say. That's what
My
they
CPA
all
is mad at
say.
me. I was late.
I'm normally so good at this. Okay. Yeah, sure.
Yeah, yeah. Anyway, welcome here. I think we're recording. Yeah, we are. I'll just put a quick sound mark so that we can edit the video. Welcome, everybody, to the Alternative Investing Club. Today is October the 10th, 2025, and we have a special treat with us today. We have Brandon Hall from the Real Estate CPA podcast. Oh, I'm sorry, did I say that right?
It used to be tax smart real estate investors today, but yeah, it
Oh,
used to be
gosh,
real
yeah.
estate. That's a big throwback.
I told you I've been a listener for a while.
That's great.
Anyway, Brandon, welcome here. We've got a little 66 people in the room or so. It'll probably go up over the next few minutes. Why don't you introduce yourself and let us know what you do?
What's up, everyone? My name is Brandon. I run Hall CPA. We are a national CPA firm, and we provide tax and accounting services, and about to be some additional services like cost segregation studies to real estate investors nationwide. Most of our clients, I think, on a percentage basis, like some 30% of our clients are in California. I might have misquoted that a little bit, but we've got clients in every single state. I have a team of 55 in the United States and another 45 or so offshore. So a relatively large operation at this point. We are a top 400 CPA firm, so we're one of the 400 largest firms in the United States. And all that means is just that we now have access to much higher level talent, more sophisticated talent, and we can start bolting on some really unique service offerings to continue to add value to our clients. I got my start back in 2015, 16. I was working at PwC and EY, Ernst and Young, for a little bit. I was a consultant at both of those firms, and I was trying to figure out how to get out of the corporate grind. I did not want to stick around for 15 years to make partner. And at the time, especially, I had an ego the size of Mount Everest. So I just thought I was way better at all this stuff than my managers were. So I decided to just strike out on my own. I was on Bigger Pockets answering a lot of questions. I was trying to figure out how to invest myself, and then saw that people were asking tax questions. So I just started answering those, and that sort of snowballed into taking on a few clients on the side, and eventually going full time into running my firm. So I went full time into my firm in 2016, and the growth has been phenomenal. It's been a lot of fun, a lot of ups and downs. Being an entrepreneur, regardless of what type of entrepreneur, when you're trying to grow something, there's a lot of wins and there's a lot of losses. So I've experienced a lot of things, but overall it's been great. I have 24 units myself. And so I'm a real estate investor as well, multifamily, single family, and short-term rentals. So kind of do it all, and actually kind of trying to divest a little bit from that and just focus more on the business itself. But that's a little bit about me.
All right, excellent. For those, I know the entire audience here knows, but Brandon, everybody's going to put their questions inside the chat, and while you're talking, did you forward a presentation, or are we just doing a chat?
I've got one.
Okay.
We can do either. We can do a chat.
Yeah, no, go
presentation,
ahead and bring
you
your
guys
presentation up. That's usually
Okay.
what happens here. And as people have questions, they'll put them in the chat, and I can judiciously interrupt you for on-topic questions. Or, if you want, we can hold them all to the end.
No, go ahead and interrupt me for
Okay.
the questions. I think that'll be good. I always love actually just structuring things as a chat, but I kind of use the
Yeah.
presentation as a guide. So let me get this pulled up real quick.
About 2 years or so ago, we had a vote, and the vote was to keep presentations going because sometimes the chats became a little unstructured.
Yeah. Sometimes when I do this and there is no structure, sorry, I'm pulling up this little remote control thing. Sometimes when I do this and there is no structure, people will start like asking me deeply personal tax questions. I'm like,
Yeah.
I don't know, man. This is getting a little too.
I'll be your filter there for those.
All right.
And
Here we go.
of course, feel free. You've got your contact information there. If you've got deeply personal questions, and I don't know if you're taking new clients this year. Obviously,
Always.
It's pretty close to the end.
Oh, well,
But
yeah. We're not taking clients for 5 days from now, but
Yeah.
we're happy to help you otherwise.
right. Feel free to reach out to Brandon, of course.
Cool. All right, guys. So today's presentation, what I'm going to do is I'm going to start by giving you a quick primer on the tax code and how it's structured. I have found that people are often confused about our progressive tax system, so I do want to talk a little bit about that. Then we will go into some strategies that you can use, and then also some scams to avoid at the end. Oftentimes, when we are working with high income or high net worth individuals, you are being marketed a lot of scammy type of products, and you are very emotional when it comes to paying taxes. So, and they play on that. They play on that emotion that you feel of the anger of having to pay whatever percentage of your income to the government. So I want to keep you out of those scams. I'm happy to talk about the audits we've helped represent as well. My firm, when we work with a client, we start with tax planning always. So a new client comes in and we're going to look at your whole situation. We're going to understand what your goals are for the next 12, 24, 36 months. And then we're going to say, look, there's a ton of strategies out there. Here are the 3 or 4 that you need to focus on. Just do these things. This is your action plan. And now we're going to follow up with you periodically to make sure that you're actually executing on that action plan. That's where clients start with us. Then they buy tax preparation. And then we provide audit support and anything else that they need to ensure that whatever tax savings that we've helped them get, they actually retain. There's a lot of accountants out there that have actually copied our podcast. They'll take the short-term rental stuff and the real estate professional stuff and they'll go make it their own. And they will let their clients jump through hoops or take shortcuts. The best one is real estate professional status and the short-term rental loophole, where they will tell their clients, don't worry about keeping a time log. We'll take the position for you anyway. That is a terrible accountant. If that's what your accountant is telling you, find a new one, because the way these audits work, at least in our experience, serving a lot of these clients that are coming to us once they're audited, they're coming from certain preparers. In my theory is that the IRS, when they find a vein of gold, why would they keep trying to play whack-a-mole, right? They would just keep looking at that one accountant who's preparing these false tax returns, right? And just keep pulling those clients, because we all have identification numbers that we have to send to the IRS whenever we're preparing returns. So it's really, really important that we get this stuff right. And again, like I'm as aggressive as we can be, but I'm not going to do something that's blatantly wrong. And that's the way that we try to help our clients win at the end of the day. All right. So we are going to start with how we pay so much in taxes. So first off, if you have a W-2 job, or you're running a business, or you have a W-2 job and a business, you can be taxed up to 37% at the federal level. But then you also have state income taxes, right? If you're in California, that's a 13.3% maximum. Here in North Carolina, our tax rates are actually going down. So we have a flat rate. And they're reducing their tax rate over the next like couple years, I think. So we're at like either 5 or 4.75 now, which is awesome. And sometimes you even have local taxes, like New York City or Pennsylvania has local taxes. Ohio has RETA taxes. So you can pay a lot in taxes just from the income taxes alone. But then what I've found is a lot of people forget about the FICA taxes that they pay, that 7.65% that gets pulled out of your W-2. You don't even feel it. You don't see it. But we forget about the fact that that 7.65% actually exists. And if you're self-employed, like myself, you get the wonderful benefit of paying both halves of FICA taxes, because if you're a W-2 employee, you pay 7.65 and then your employer pays 7.65 payroll taxes. But when you're an employer and self-employed, I get to pay myself as an employee and also as the employer. So I get to pay a 15.3% tax on every dollar of my earnings, which is phenomenal. When you add all of this up, it's not uncommon to see high income earners paying more than 50% in taxes. Most of them are around like 45%, but you can get up to 50% depending on how especially if you're running a business, how that's all structured. And again, we're considering here FICA taxes too. So it's not just strictly my income taxes. If that seems high to you, factor in those FICA taxes, and all of a sudden, it's not going to seem that high. So we pay a lot in taxes. If we pay a lot in taxes, the goal is to reduce our effective tax rate, not our marginal tax rate, our effective tax rate. You can be in the 37% tax bracket and still reduce your effective tax rate. And the way that we do this is we invest in assets that produce tax advantageous cash flow, such as real estate. So let's start with an example. Let's say that we have a physician earning $500,000 and they pay $225K in total taxes. All right, all the taxes in federal, state income taxes, local taxes, FICA taxes. They pay $225K. Their effective tax rate is 45%. So to reduce their effective tax rate, we invest in something like real estate that produces cash flow, but doesn't require me to pay tax on the cash flow, at least today. So here's how that works. Let's say that I buy real estate and the gross rental income is $30,000. Expenses are $20,000. So before, and let's just to keep things simple, because I was doing this presentation one time, and they're like, "What about a loan?" So just to keep this simple, let's assume we bought this property 100% cash. Okay, so there's no loan. So $30K of rent, $20K of operating expenses. I've got $10,000 of net operating income left over, and that's gonna be my cash flow. So that actually hits my pocket. $10,000 hits my pocket. But then we factor in depreciation expense, because when we buy investment real estate, the property deteriorates over time, and the IRS gives us a credit in a way to recognize that deterioration, and that is called depreciation. So depreciation is basically just saying, hey, the roof and the windows and everything like that, it falls apart over time, and so we're going to try to map that a little bit via this deduction that you get to claim every single year. The depreciation calculation is improvement value divided by 27.5 years or 39 years, depending on what type of property you buy. It does not matter how you finance the property. So the depreciation calculation does not change if I have 100% financing, 70% financing, or if I paid all cash. Back to the example. $30,000 of rent, $20K of expenses, $10,000 of operating income, but I have $12K of depreciation. So I get to tell the IRS that I lost $2,000 because I had $10K of net operating income minus $12K of depreciation. So that's a net negative $2,000. So when I report this on my taxes, I tell the IRS I lost $2,000. But I just told you, since we bought this 100% cash, that $10,000 of net operating income is also cash flow. So that cash actually hit my pocket, right? And so if we go back to the doctor example now I have $510,000 of total income. But because that 10K, it's not going to show up on my tax returns as 510, by the way. This is kind of where it gets a little weird. You have to keep track of this. But that 500, that extra $10,000, that's not showing up on my returns. That's a $2,000 tax loss on my returns. So now I've got 510K of total income, but my taxes are still $225,000. So my effective tax rate has been reduced from 45 to 44.1%. Now, some of you might be like, that's not cool. I don't like that. I'm still paying 44.1%. What gives? The key here with taxes is to think long term. I know, like, real estate professional status, short term rentals, it's all great, right? You get the big tax benefit, and we're big proponents of it. If you can get the big tax benefit in 1 year, amazing. But tell me what your 5-year plan is, your 10-year plan is, your 20-year plan is. Can we think in terms of decades? Because if we can think in terms of decades, we're going to make smarter and more optimized decisions. And that's what I want to teach you, is that yes, it's one property, and yes, it's 45 to 44.1%. But if you do this 10 times or 20 times over the span of, say, 10 years, 15 years, now, and let's just assume it's the exact same property, 30K of rents, 20K of operating expense. Now you'd have an extra $200,000 of cash flow that you will not pay tax on. You're actually going to tell the IRS you lost $40,000 on that $200K in cash flow, right? 20 properties times a $2,000 tax loss thanks to that depreciation. So now that same physician goes from earning $500K to $700K, but they're still going to pay the same $225K in taxes. Now their effective tax rate is 32.1%. That is tax optimization, right? And this is without real estate professional status, short-term rentals. We're not even factoring any of that in. So now we're making a lot of money, and we're chipping away at that effective tax rate over time. That's the long game that we want you to play. And I kind of developed this thesis because at my firm, we work with people that are at all ends of the journey, meaning we work with people that are at the very beginning of their investment journey. They're buying their first rental. We work with people kind of in the middle. They're on rental 10, 20, 30. And then we work with people that are at the very end of their journey. They've been doing this for 30, 40 years, and they've accrued 20, 30, 40, $50 million of assets. Those people at the end of their journey don't pay taxes. And if they do pay taxes, it's very minimal. But this is what they were doing the entire time, is figuring out, how do I optimize? How do I put money into a tax optimized asset stream or income stream, which is real estate. And there's others out there, but real estate, in my opinion, is the best one. And how do I do that consistently over time and redeploy the capital consistently over time to create income streams that are tax advantageous? And you can absolutely achieve this without having to jump through any of the crazy hoops. So let's talk about what the top 1%, how the top 1% use the tax code. Some of you might be top 1%, so this might not be new to you, but I want to talk a little bit about this. The first thing that they do is passive activity netting. We're going to spend some time there because this is something that nobody talks about. It's not fun to talk about because at least on social media, because it's not that interesting. It requires a long-term view. Everybody loves to talk about real estate professional status, short-term rentals that you also see here on this list, because that's the immediate, like, I can make you happy tomorrow because I can tell you exactly how to save $80,000 in taxes today. How does that sound? But again, we want to think long-term, and that's where passive activity netting comes into play. And I'll explain that in a second. The fourth and fifth strategy are run the burr strategy and swap until you drop. So let's talk about passive activity netting. Now, in that example that we were talking about, the physician has $2,000 of tax losses thanks to depreciation, even though they had $10K of net income. In that example, you have to ask, what happens to the $2,000 of tax losses? And that is where the passive activity loss rules come into play. So Section 469 of the Internal Revenue Code was implemented back in 1986. So prior to 1986, these rules didn't exist. It was a great time to be a landlord. Then 1986 comes around and Congress basically decides, hey, you know what? These real estate investors, these rich people should not be using real estate to offset their regular income. That's not fair to everybody that doesn't own real estate. So the passive activity rules came into place to essentially stop what Congress saw at the time as a tax shelter, and make it a lot harder to claim tax losses that your real estate generates. So when my rental produces cash flow of 10K, but I get to tell the IRS that I lost 2,000, I have to go to the passive activity loss rules to figure out if I can use that $2,000 tax loss. If I can't use the $2,000 tax loss, then it gets suspended and it gets carried forward on my tax returns indefinitely. Now, quick note on suspended losses. Form 8582. I'm going to say this again because I want everybody to write this down. Seriously. Form 8582 is probably the most important form in your tax returns. More important than your 1040, more important than Schedule E, Form 8582. And this is especially true if you've held real estate for some time. Hold on. Now I'm like second guessing myself. Form 85882. 85. Yeah, I'm right. Form 85. I was like, wait a second. Did I just say the partnership form? No. Form 8582. It's the most important tax form. The reason why is that form is going to aggregate all of your suspended losses. And it's going to net those suspended losses out against your current year passive income. And when you sell a passive activity, by the way, we see this mistake a lot. When you sell a passive activity for a gain, the gain on sale is considered passive activity income. So your suspended losses can offset or can be unlocked up to the amount of the gain on sale of a passive activity. Meaning, if I own rental real estate myself and then I invest separately as an LP in a syndication deal, the syndication liquidates at a gain. My rental losses that I have can offset the gain on sale from that syndication. Okay. So it doesn't have to be like an LP deal offsets an LP deal or a rental offsets a rental. I could have my rental losses offset my business income if my business income is passive. Maybe I go and invest in the local hair salon. They need capital for expansion and I give them 100K and they give me $10,000 of income back every year. That's passive income because I'm not materially participating. So my losses, my suspended losses from my rental real estate can offset that type of income. All right. So it doesn't have to be rental to rental. That's the point I'm trying to make. But your suspended losses are detailed on Form 8582. The reason that it's the most important form, in my opinion, is because that is a manual input whenever you switch accountants. Okay, so if Daniel decided to switch accountants, the new accountant would have to pull up Form 8582 and properly code all of that information into the new software that the accountant uses. And the problem with that is if you're doing this on October 10th, you're probably not going to do it very well. Like if I'm the accountant, right, and I'm doing this on October 10th, I've got another 80 to do. I'm probably not going to get yours 100% right. So everybody makes mistakes, but what I want you to do is look at your tax returns, go down to Form 8582, and I want you to create a spreadsheet that you update once a year. And that spreadsheet needs to detail the suspended losses that Form 8582 reports per property every single year. Because if you switch accountants, you want to make sure those suspended losses get moved to the new accountant. And that is a manual entry for the new accountant. That's a manual entry. We have found and corrected many mistakes related to this specific issue over time. It's actually something we now specifically look at. So make sure that you're tracking it. Otherwise, your suspended losses might just disappear and you might have no idea where they went. And that happened to one of our clients that came on, I think it was back in 2019, and that got me on this whole spiel. So anyway, I'll get off my high horse about Form 8582. But let's go back to passive activity. So we've got this $2,000 tax loss thanks to depreciation. Can we use it? Now we have to look at the passive activity loss rules to determine if we can use it. The passive activity loss rules say all rentals are passive unless you are a real estate professional. And also, any trade or business that you do not materially participate in is passive. So all rentals are passive unless you're a real estate pro. That means that my rental loss, that $2,000 tax loss, is a passive activity loss. And the problem with that is my regular income, my CPA firm income that I'm earning, my W-2 income that I'm earning, my spouse's W-2 income that she's earning, all of that is non-passive. Okay, so that's in a completely separate bucket. So you've got this passive bucket that all of my rentals get pushed into automatically. And then you've got the non-passive bucket where literally every other piece of income is. Dividend income, interest income, all of that's considered non-passive. I know it sounds weird, but that's what it is. It's all non-passive. So basically, again, Congress's whole goal here was to prevent rich people from using real estate as a tax shelter. So they said it's all passive, too bad, so sad. And you can qualify as a real estate pro to move it from that passive bucket to the non-passive bucket. But you do have to qualify as a real estate pro, and we'll go over that here in a second. So if you can't do that, your rental is passive, and the losses are suspended on your tax returns unless you have passive activity income. So if you have passive income from other sources, rentals, LP deals, maybe they liquidated, maybe they just made distributions, businesses that you're not materially participating in, that passive income can be offset by the passive losses. So they can net out against each other, but you can't use your passive losses to offset your regular income. Oftentimes when we're working with LPs, limited partners in syndication deals that are new to investing in real estate, they get really disappointed when they get that K1 back and it says they have a tax loss of $75,000 that was passed back to them, and we're not reporting that on their return, and they get really upset. And we sit down, we educate them on how the passive activity loss rules work. That is a passive loss. Your income is non-passive. The passive losses cannot offset non-passive income unless you qualify as a real estate professional. You don't, so it's passive, and it gets suspended and carried forward. So that's kind of how the passive activity loss rules work related to rentals. Now, that second bullet point there says any trade or business in which the taxpayer does not materially participate. That is also a passive activity. So what does that mean? That is like if you, the example I like to use is investing in my local hair salon. I love them so much, and I hope that one day they'll call me up after seeing one of these presentations and say, can you give us 100K to expand? Because they're great. They're phenomenal. So if I did that, I don't know anything about cutting hair, except for the fact that, I like my hair, done a certain way, but like, I don't know anything about cutting hair. Otherwise, I don't know anything about operating hair salons. So I'm not going to materially participate in that business. I'm not going to advise them. I'm not going to vote. I'm not going to be there. I'm not going to be cutting hair, right? I'm just a capital partner. I gave them 100K. They're passing me $10,000 back, or 12, or whatever profits that I get allocated back every single year. The profits that they pass back to me, that's passive income, because I'm not participating in the business. And that passive income can be offset by passive losses from my rentals. But that's what a trade or business in which you do not materially participate means. My CPA firm income is non-passive income, right? Because I materially participate in my CPA firm. I'm working at it every single day. So I could never make this passive income, but I could make investments in businesses passive as long as I don't materially participate. So now that we have a primer on the passive activity loss rules, let's talk about passive activity netting. The idea here, again, is that passive losses can offset passive income. So as you build your real estate portfolio, and remember, we're taking a 2-decade approach, okay? Not like a next year thing. What happens over 10 years, 15 years, 20 years? As I'm investing in real estate, most investors end up accumulating suspended passive losses. They accumulate suspended passive losses because real estate is just such a phenomenal tax shelter. Even when you're a real estate pro, even if you do the short-term rental loophole, most likely you will still end up accumulating suspended passive losses at some point in your investment journey. So the idea is, instead of like trying to jump through hoops and really work really, really hard on unlocking those losses, just go and invest in activities that are passive to you, that produce income, such as businesses, right? So go and invest in the hair salon. And if you're like, well, I have no idea how to do anything like that, and that's super high risk, I agree. But there's also funds out there, just like there's syndicates for real estate and real estate funds that pool money to buy real estate. There are also funds that pool money to buy businesses. And it's not like, you don't have to be like super, super, super wealthy private equity, family office type of deal. These funds exist everywhere. It's just a matter of networking your way into them to realize that they do exist. But you can give them money, and they're going to go and invest in an HVAC business, a plumbing business, a crawl space restoration business, a roofing business. And now you've got a little bit of diversification, and a lot of these small businesses, and the income coming back to you is passive. That passive income can be offset by the passive losses from your rental real estate. So this is what our most sophisticated and wealthiest clients end up doing. They play real estate as the main game, and then they go and invest in businesses at the same time. And so the suspended losses that are accumulating on their balance sheet actually don't accumulate that much. They accumulate and then they get knocked down by the passive income from the businesses. And then it's just a balancing act of trying to make sure that those two income streams offset each other, essentially. And it's a beautiful thing because my real estate's actually producing positive results. It's producing cash flow. It's producing appreciation with the market. But at the same time, I get to report a tax loss. And that tax loss is then going to go and offset this business income from this investment that I made on the side. And so now I'm getting all this cash flow and I'm not paying taxes on it. And that is how some of our clients earn 7 figures without paying a dime in tax. It's really incredible to watch. I'm not there yet personally, but that's the goal. And seeing this actually play out is phenomenal. But that's the passive activity netting strategy. It's just being thoughtful about my portfolio. I personally love it because I personally don't want to go be a real estate professional. I have zero desire to personally go and be a real estate. I know I preach about it, and by all means, you should go and do it. I don't want to go and do it. I don't want to go and spend 750, 800 hours swinging a hammer on my rentals and dealing with the tenants and all that type of stuff. I just don't want to do it. So I don't have to do it, right? I can build a real estate portfolio, accumulate suspended losses, and start making business investments. And those business investments can produce positive income that tap into those suspended losses. And now I'm getting the tax optimization that I'm looking for without having to jump through any additional hoops. It's awesome. It's amazing. Anyway, that's what passive activity netting is. So let's talk about real estate professional status just very briefly. So I want to leave some time for questions at the end. Are there any questions that we need to pause for, Daniel, so far?
There's a couple of questions, but honestly, we can hold them for a little bit. We can keep going.
All right, sweet. Let's rock and roll. So real estate professional status, this is the apex of tax planning with real estate. Essentially, qualifying as a real estate pro allows you to move your rentals from that passive bucket. So remember, rentals get pushed in this passive category, and real estate professional status allows you to move them out of that passive category and into the non-passive category where all of your other income is. The significance of that is that if your rental is non-passive, then it produces a large tax loss, you can use that tax loss to offset your regular income. You can use it to offset W-2 income, business income, interest, dividends, capital gain on stock sale. You can use it to offset retirement rollovers and cash outs and any type of income that you earn that is not passive income. As long as you move the rentals to the non-passive bucket, you can use the rental losses to offset any of that type of income. Very powerful strategy. I like timing the real estate professional status election. So a lot of people hear this and they go, "Oh, I have to be real estate professional status. I have to be real estate professional status tomorrow." And I'll say, whoa, wait a second. Why don't we be a little more strategic here? This is, again, why we go through goal planning with our clients, because we want to know what's coming up over the next 12, 24, 36 months. Let's say that you know that there's some big, payout that's coming, or maybe you qualify for a milestone bonus or some sort of big event, some sort of big income event in 2 years. Well, we would tell you, hey, don't worry about real estate professional status right now, but instead focus on acquiring real estate. Acquire as much as you can, because in 2 years, what we can do is you can qualify as a real estate professional at that time, assuming that the stars align and that you meet the qualifications. And at that time, that's also your big income event. So that's a good time to qualify as a real estate pro. And also, we can retroactively cost segregate all of the properties that you've acquired that you haven't yet cost segregated, and we can use all that bonus depreciation to spike the year that you qualify as a real estate pro. So in the 1 year that you have this big income event, we can be a real estate pro in that 1 year and use all the losses in that 1 year to offset that big income event. So you don't have to just go out and be a real estate pro tomorrow. Think a little bit strategically about it, because it is a lot of work. You have to spend 750 hours working in real estate. And you have to spend more time working in real estate than you do anywhere else. So if you have a full-time job like me, or you run a business full-time like me, I can't qualify as a real estate pro. The IRS will never buy it, and neither will a tax court. So if you have a part-time job, you could qualify, right? Because you have to spend more time in real estate than you do anywhere else. But if you have a full-time job, you're out. So what a lot of our clients do that have a full-time job, like typically the breadwinner full-time job, they'll have their spouse qualify as a real estate pro. And spouses like stay at home, or spouses working part-time, or runs a little business or whatever. But that the spouse will step in and qualify as a real estate pro, manage the rentals, and now on a jointly filed tax return, you effectively have a real estate professional status tax return. So you can cost seg the rentals, you can use the tax loss to offset the high income spouse's W-2 or business income. Very powerful strategy. My one recommendation on this is to just make sure that your spouse actually wants to be in real estate. That's kind of an interesting conversation, right? Like typically our clients that we're working with are all of the high income spouses, right? And they're like, I hate taxes, and it's like chipping away at my mental health and everything. It's terrible. My spouse is gonna be a real estate pro. Well, have you run this strategy by your spouse? Let's get him or her on the call just to make sure that we're all on the same page. Because a lot of times spouses don't want anything to do with the rentals, so it's really important to make sure your spouse is on board with this. But if they are, your spouse can qualify as a real estate pro, materially participate, and the whole tax return is a real estate pro tax return. Now you can use your rental losses to offset your regular income. It's awesome. Yes.
Hey, Brandon, as soon as questions were mentioned and I said, "Oh, you can go on," that's when the questions started coming, or quite a few of them. We had a few before, but if you want to take a few, we can do that now.
Okay. Yeah, sure. Yeah,
I'm going to jump up a little bit towards more towards the beginning when you were starting to talk about depreciation. Um, Anika, I believe is how you say her name, is asking, what happens when you sell your property? Do you need to recapture the depreciation?
Excellent question. Yes, when you sell your property, you have depreciation recapture. Here's how it works. Let's say that you bought a property for $1 million, and you depreciated it $200,000 over the hold period, and then you go and you sell it for $1.1 million. Most people would automatically assume, hey, million, I bought it for $1 million, I sold it for 1.1, I've got $100K gain, but that's only partially true. When you go talk to your accountant, they're going to say, hey, you depreciated at $200K, so your adjusted basis is $800. You sold it for 1.1, so your total gain is $300K. $200K of that gain is coming from depreciation, and that is why it's called depreciation recapture. $100K is coming from appreciation. You do have to watch out for this, especially if you recently, over the past few years, bought some short-term rentals. We've had some clients buy short-term rentals in like the Smokies and things like that, where they bought it for $1 million and now they can only sell it for $900K, but they depreciated at $300K during the hold period. So they bought it for $1 million, depreciated at $300K. The adjusted basis is $700. They're selling it for $900. They're thinking, I bought it for $1 million, I sold it for $9, I lose $100K, I get a tax deduction. But when you actually put pen to paper, it's I bought it for $1 million, my adjusted basis is now $700. I'm selling it for $900, so I actually have a $200K gain that I now have to pay taxes on. And that's a dangerous situation. So yeah, so depreciation recapture can really bite you. Now, there's a lot of ways to avoid depreciation recapture. The main way is just to keep kicking the can down the road. You can do a 1031 exchange or a lazy man 1031 exchange, which we'll talk about here in a second. But a lot of our most sophisticated clients, the ones that have built these big portfolios over a 30-year time span, they just kind of operate under this principle that once a dollar goes into my real estate portfolio, it doesn't come out, at least in the form of a sale. If I want to extract the dollar, I do that with leverage. So I get a line of credit. I recapitalize a property and pull cash out, because debt is not a taxable transaction. So if I refinance a property and get cash, no tax due. And so they just play that game of just hold property forever or leave my dollar in real estate forever.
All right, this is a quick question here. Henry's asking, is the Form 8582 turned over to the IRS every year? And do you have to keep it correct? Okay, there you go. The other option is just something you update as you go. And no.
Well, both. Yes, you do update it as you go, because it reports your cumulative losses. Every single year it's going to change based on your current year's performance, whether or not you sold property or not. But it is sent to the IRS every single year, yes.
Manju is asking, how about SDIRAs? Passive losses, can they be captured?
So SDIRAs are kind of their own separate vehicle. If you have a loss in the SDIRA, the SDIRA reports it. Say. Yeah, but it's not going to benefit you. So my suggestion is if you want to use retirement accounts for real estate investing, you actually consider getting some debt exposure with those retirement accounts, meaning that instead of investing in like syndications or funds, I would use my retirement accounts to invest in note companies, um, like companies that lend money, because the companies are going to give you interest, right, on your money that you give them, and that is a great tax shelter for interest income. Otherwise, you can't really shelter interest income. And then lending is also relatively low risk compared to investing as an equity owner in syndications and funds. You get preference and all that type of stuff. So my suggestion is, you're going to use retirement accounts, you actually use that from a lending perspective. So you're in the lender position with the retirement money, because real estate's so tax advantageous that layering on the retirement account on top of that doesn't really help you from a tax perspective. To be clear, you can do whatever you want with your money, but if you're trying to optimize taxes, real estate's already extremely tax optimized, so you don't need to layer on retirement accounts.
Dennis is asking, can these passive losses offset capital gains from selling stock?
No, good question. So passive losses are passive. Capital gain from stock sale is non-passive. It's actually considered not from a passive activity technically, which puts it into the non-passive bucket. It sounds weird, but again, you got to remember the intent of Congress was 1986. They saw all these rich people using rental real estate losses to pay no money in taxes. So that was the focus. It was, how do we make sure that rental real estate is just on its own separate island? And then they grouped in any business that you're not materially participating in as well.
All right. Shale is asking, how do I know if a rental produces passive loss? Usually rentals on single family homes are income producing, at least in California.
Well, most rentals are income producing. So that's a good question. There is a difference between net operating income and taxable income. Okay. So net operating income hopefully is positive. Better be positive, or you better have a really good reason why it's not positive, right? And my net operating income is my rental income minus my expenses, and this is before figuring out debt. So leave debt aside, like debt coverage. Leave that aside for now. Rental income minus expenses equals net operating income. Ideally, that should be positive, right? But even if that is positive, and even if that's positive to a large degree, you still have depreciation that comes in after that is figured out. And the depreciation piece is specifically for tax reporting. So I could have $10,000 of net operating income and still tell the IRS that I lost money because I might have 12K of depreciation. So depreciation is an expense that's stacked on top of that net operating income. I hope that makes sense.
And here's kind of a similar question. Would a REIT income be considered the same way, passive? Or is it business
Actually, that is a good question. It depends on how you own it. If you're getting a K1, then yes, it's passive. I think. Don't quote me on that. Actually, I that would be a good question for my national tax office. I've hired these genius tax people that they've got like the code cited in their mind and memorized. I want to say that yes, as long as you're getting a K1, that's passive, but I'm 90% confident.
Okay. It's kind of odd. I always thought it was taxed at income rates, right? So it's income rates, but passive potentially.
Yeah, I think so. I mean, it's all income rates, right? Like even the rental losses are technically your regular income rates, but it just produces passive losses, so you never really feel it.
Gotcha.
Yeah.
Okay. Another question on does this work with a Roth self-directed IRA?
Yeah, again, you can invest in real estate with whatever tax advantageous vehicle you want to. But my prior comment still stands in the sense that I would strongly recommend that if you're using any sort of IRA, SD IRA, solo 401k, that you really consider applying that money in a more of a lender type of format, because you're going to generate interest income, which is safer income, and generally safer income. And because that interest income is coming back in the retirement account, it's automatically tax sheltered. Versus if you had interest income coming to you separately outside of a retirement account, you can't shelter it. It's almost impossible. But investing in real estate outside of a retirement account is highly tax advantageous. So that's what I'm trying to. It's like you're trying to layer on these sheltered accounts, but you don't need to if you're investing in real estate as an owner of the real estate.
Daniel Gould is asking, if I sell real estate with big capital gains, can I offset those capital gains by purchasing rental units in the same year if I'm accelerating the depreciation on those new buys?
Yes, that is called the lazy man 1031 exchange or swap until you drop. Actually, I don't even know if I put it on here. But anyway, yes, absolutely. I love that strategy. And somebody else that asked about the capital gain on stock sales, this is where it's different, okay? Because what we're talking about now, like if I have Apple stock and I sell Apple stock, that is not a passive activity. That is a capital gain from a stock sale of a publicly owned company, and that is different, okay? When I own real estate and I sell the real estate is by default a passive activity. And so the gain on sale, all the capital gain, all the depreciation recapture, all of that gain is considered passive activity income. And passive losses can offset passive activity income. So we're putting on our big brains now. We're like playing 4D chess here. I love this question. What's really going on is I'm selling a property at a gain and I'm buying additional properties in the same calendar year. Doesn't matter which transaction happened first, right? One could happen January 1st, the other could happen December 31st, as long as it's in the same calendar year. The property that I'm acquiring with the proceeds or extra money that I have, I'm going to cost segregate that property. I'm going to get the tax loss going, and that tax loss can offset the hill from the rental that I sold. I actually just deployed the strategy myself this year. So yeah, 100%. You can use suspended losses to offset the gain on sale too. So if you can't get it in the same calendar year, not that big of a deal as long as you understand how the timing works on these things. But yeah, it's a great strategy. We call it the lazy man 1031 exchange because you end up in the same position as a 1031 exchange. Like a 1031 exchange is I'm selling property A for property A plus 20%. So I'm trading up and the basis gets carried forward. Well, if I just sold property A and then I bought property B and I cost segregated property B, guess what? Going to have about the same basis that I would have had anyway with the 1031 exchange. So it's a lazy man 1031 exchange. You get basically the same tax result without jumping through all the hoops of the 1031 exchange. And this is not a knock on 1031 exchanges. I love 1031 exchanges, but timing doesn't always work out. And sometimes we don't like to be beholden to all the rules of a 1031 exchange.
All right. The questions are rolling in now. So I guess if you want to continue your presentation, we can, or we could just do questions the rest of the time. We've got 9 minutes left.
Let me hit the tax scams to avoid because I really want people to wrap their minds around this, and then I'll just answer questions the rest of the time.
Also, do you want me to share your emails? There's questions. There are requests for your contact information.
Yeah, okay,
sure. I'll put it in the chat.
I've got something on the next page too.
Okay.
All right. Tax scams to avoid. So the first two are not technically scams. Okay. Equipment leasing businesses and solar syndications. These are not technically scams. These are fine investments if you want to make that type of investment. The scam part comes from the tax promises that the sponsors are making. So here's how it works. And this is always high income earners and high net worth individuals are always being pursued by less than integrity, low integrity people that want your money. Okay. That's the first thing you have to understand. Stop being emotional, be objective. Why would this person pitch me so hard on equipment leasing and solar syndications? Because they want my money. That's why. So equipment leasing businesses, here's how it works. You basically go, the tax promise is you spend $100,000 on machinery and a company that helps you facilitate that purchase. You're then going to do a master lease agreement with that company and they're going to operate it for you. And because you bought the equipment and you own the equipment, and because equipment's a 5-year life, you get 100% bonus appreciation on the entire purchase price. So I spent $100K, I get a $100,000 tax deduction. And here's the problem. That is a passive loss. It's a passive loss 100% of the time. 99% of the time. The 1% of the time that it's not a passive loss is when you are running your own equipment leasing business. If I buy a piece of equipment and then immediately hand it over to an operator, that is passive. I am not materially participating. Now, here's where the scam kind of comes into play. The operators will tell you, set up your own LLC. You're the 100% owner of the LLC. Therefore, there's nobody else to materially participate against. You're the only one operating your LLC. And the IRS has a doctrine specifically for this called substance over form. The form in this situation would be Brandon has a single member LLC. You put 100K into it, bought a piece of equipment, and hired an outside company to run with it. So the form is, hey, Brandon is the sole owner of the LLC and he is materially participating. However, the economic substance is Brandon wanted the tax deduction and he didn't want to do any of the work to get the tax deduction. And the IRS is very smart when it comes to this stuff. So if you've been approached by something like this, run away if tax savings is what you're looking for. If you're looking to legitimately invest in equipment leasing, different story, go for it. But even still, the passive losses you receive back, or the losses you receive back, are going to be passive unless you are running your very own equipment leasing business. It's like a property manager, right? We know at this point, hopefully, that if I buy a rental and I hand it over to a property manager, that's a passive activity. The property manager is the one running the day-to-day operations. Same situation here. Solar syndicates, exact same situation. So solar syndicates have this extra layer, though, of the credits, the green energy credits, right? Well, guess what? Green energy credits can also be passive and will be passive unless you're materially participating in the solar syndication business, which you won't be. So don't get bought in to these tax promises that these folks are making. I don't think that they're being malicious, to be clear. They just don't know what they're talking about. And the problem is that whenever these new tax products come onto the market, it takes about 5 to 7 years for the IRS to catch on, audit everybody, take them to tax court, and for the tax court to make rulings. So you're not actually going to be dinged for any of this for like 5 years. And then it's going to be super painful, and everybody's going to blow up at the same time. Don't do it. Don't do it. All right, another tax scam is to donate art. Seen this one quite a lot, where you buy a piece of art, then you get it appraised for some higher value. Typically, the appraiser is not a real appraiser. You don't know that, but that's true. And then you donate the art at the higher appraised value, and you write off the difference. It's just a total scam. The IRS actually has a dedicated team to specifically attack this one issue. So really watch out. Writing off your clothes, watches, private chefs, that's not true at all. I don't know where people got this idea, but I see it all over social media. No, you cannot write off your clothes. No, you cannot write off your Rolex. No, you cannot write off your private chef. All of that stuff is inherently personal, not a tax deduction. And then the last one is using trusts to eliminate taxes. Trusts are great, by the way. This is not, again, not inherently a scam, but when somebody says you can use trusts to shelter all of your income and never pay taxes again, that's the scam. And the people that set these trusts up are making $50,000, $70,000 on you. So just be really careful out there. Make sure that you are pulling in a qualified CPA or a qualified tax attorney to review the situation for you and really help you navigate the complexities, because again, we get very emotional when we're talking about saving money on taxes, and that's exactly what these guys play into. So be careful. That's my you can scan for consultation, QR code, and I think you also posted the email in the chat or something. So.
I posted it in there, yeah, and your webpage.
Great. Awesome.
Hey, just a note for those of you who are still at Intel. At least 3 years ago, when I was still at Intel, they did have a service where, for a nominal fee, they provided basic legal services. And one of those legal services that were provided was the setting up of a living trust. And so, if you are an Intel employee, I encourage you to go that route and check it out. It cost me $17 a month, and I set up my trust. It was a boilerplate trust. If I went out of pocket, they said it would probably cost me $3,000 to $5,000.
So people are saying it's still available. That's great. That's a cool benefit.
Assuming it's still there at Intel. Somebody will confirm it in the chat. All right, ton of questions here, and we've got 3 minutes, so let's just hit some of these here. Are you required to be a real estate professional on the year in which the property was put into service in order to take advantage of cost segregation bonus depreciation?
No, you do not. You can take you basically get to say, "Oops, I meant to do that." Whenever you qualify as a real estate professional in the future. So if I bought a property today, in 3 years from now, the time is ripe for me to be a real estate pro, or my spouse to be a real estate pro. We could be a real estate pro at that point. As long as I haven't already cost segged the property that I bought today, I can cost segregate it at that point, 3 years into the future, and I could take all the deductions at that point.
All right.
That is all. But let me just say that is more expensive, by the way. So us accountants, we have to file a whole bunch of extra forms. There's a lot more complexity, but it's not cost prohibitive. It's a very viable strategy. Just know that it is going to make it a little bit more expensive to prepare that tax return that year.
Uh, Jason, SK is asking, what about taxes on real estate properties? What all states do I need to file tax for? For example, I live in California, the property's in Arizona, and syndication is registered in Illinois. Okay,
Ooh.
so he lives in California, properties in Arizona, syndications in Illinois. Where does he file?
Yeah, well, so California wants your money no matter what. So you definitely, I mean, you live there, you get that, so you got to file in California. But if you move out of California, you still got to probably file in California. California will chase you around the country. Arizona, I'm not sure. Illinois, I'm not sure off the top of my head. Each state has separate filing requirements. Most states will have either a gross income test or they will have an assets owned test. So if you have economic nexus, basically, which means I either made money from this state or I own property in this state, you typically are going to have to file in that state. So I would check the non-residence rules. The states are actually pretty good about being pretty clear on it, so it's relatively easy to find out. But my assumption is that you need to file in Arizona and in Illinois. Now, the one potential caveat here is whenever you are in a partnership, which is what syndications are, they are partnerships. Whenever you're in a partnership, the partnership could file a consolidated tax return. And you would just want to find out if that has happened, because if the partnership files a consolidated return, they essentially say, hey, don't worry about it, Mr. Partner or Mrs. Partner. We're going to file on your behalf, make it easier on you. Now there's pros and cons to that. You might not like that, but it can make it easier on you. So you would first want to find out, did we file a consolidated return? If no, do I need to personally file then in this state?
All right. And one last question, because it's an interesting question here. Prolet is asking, in your opinion, what's the minimum investment that I should make in syndications, considering that each new syndication adds another tax K1 to my tax return? So she's trying
Yeah,
to
it's a good question.
offset, huh?
It's a good question. Um, so, I mean, from a pricing perspective, like a compliance perspective, adding a K1 is maybe a couple $100. If you have the problem is when you add a K1 that's in a different state, like a brand new state that you have not invested in yet and you don't live in, because every time you do that, your accounting firm has to go and figure out, do you basically the last question I just answered, do you have nexus in this state? And that takes time and resources to do. And so typically that is when it's going to be a little bit more than a couple $100 to add another K1. But I would not let my tax compliance dictate my investment strategy. I mean, it's a consideration. Absolutely, it needs to be. You need to be thoughtful about it. But I wouldn't be. I would not be deterred to invest in something new if the compliance cost was a couple $100. That's just the cost of doing business, and that situation exists in every industry. In any investment that you make, there's always some level of compliance that's associated with whatever capital you're placing. So that would be my recommendation. I don't know the amount. I mean, obviously you can get some economies of scale for sure, right? Because 1K1 is 1K1, whether it's 100K or a million. So that's certainly a consideration. But I don't know. I guess my answer to this question would just be, I would not let compliance totally deter me from making an investment that I was otherwise bullish on.
That's a good answer. I was very curious what you were going to say about that. All right, everybody, can you take yourselves off of mute and thank Brandon for coming in and being with us today? Also, thank his hair salon as well.
Thank you,
Brandon.
Brandon.
Thank you.
Thank you,
Thanks,
Brandon.
everyone.
Thanks, Daniel. Appreciate it.
Thanks, everyone.
Thank you, everybody. It's great to see you all here. And of course, we will see you again next week here at the Alternative Investing Club. Have a great weekend, everyone.
You too, Daniel.
Thanks, Daniel, for having me.
Yeah.